Good morning. Welcome back to another Morning Cup of Joe. Happy Monday. Last week we spent a lot of time talking about the risk associated with the market, coming up along the highs that we've seen over the last decade plus. Also, we talked about the shorter term trends as we've seen momentum change in the marketplace. The question we asked last week was, do you take the risk off trade? Do you hedge your portfolio? Our answer to that was not until the shorter term trend was broken, and if you took that advice, it was well heeded and things worked out well for you. The sequestration came and went, and there was no effect in the marketplace. Momentum is flowing into the market and money still keeps coming in, as you can see the rise that we've seen through the last week. This past week we've had two major events. Number one, the banking stress test towards the end of the week, and the passing away of Hugo Chavez midweek, which we thought was going to affect the oil market, and yet nothing transpired. Again, leading us to the momentum play. Out of the four sisters, the Dow, the S&P, the NASDAQ, and the Russell has been outperforming for the year. We wrote a Morning Cup of Joe back on January 7th, stating why we felt that the IWM, which is the ETF for the Russell, was going to outperform for the year. You can look back and read that if you wish, but it looks like it's right until this day as we still see it going forward. On Friday of last week, the major shift that we are seeing is in the unemployment numbers. You've seen non-farm payrolls come out at a 40% increase above what was originally estimated. They came in at 236,000 jobs versus the 171 anticipated. Again, 40% increase. You're also seeing unemployment drop again. We're at 7.7% versus the 7.9% that we were at earlier. This is leading economists to say that we should have a 2% GDP going forward throughout 2013. But the question remains, where do you put your assets? Rocket, Josh Wells, on Friday wrote, and the Week in Review, if you care to look at that, about how the separation in between industry groups and the larger sectors and where you can find that valuation. The name of the game is not to do what the S&P does. The name of the game is to outperform it and yet do it with less risk. Today, we're going to talk about that. And if you'd like to know more, you can read on. Thanks for listening.